If you live in the United States, I am sure you've heard buzz about this new tax provision that some are calling no tax on tips. This was just introduced as part of the One Big Beautiful Bill Act, which was officially passed by Congress and signed into law on July 4th of this year. I'm going to go over what that means for you, and hopefully this information can help you save some money this upcoming tax season. Now keep in mind, this video is for informational and educational purposes only and is not intended to be a substitute for professional tax advice. You should consult with a qualified tax professional for advice tailored to your individual circumstances. And with all that out of the way, let's get started. The first thing to point out is that this new law does not actually eliminate all taxes on tips. Crazy, right? It's a catchy name, but it's not the whole story. Instead, what this law does is introduce a new deduction. Qualifying workers who earn qualified tips can deduct up to $25,000 of that tip income from their gross income when calculating their federal taxable income. Let me emphasize that again. Federal taxable income. This is a key distinction because this new deduction does not apply to FICA or state income taxes. The bill states that the deduction is for qualified tips. And this means voluntary cash tips, including those from credit and debit cards, from customers in occupations that traditionally receive them. However, some professions like lawyers, doctors, and accountants are explicitly excluded from this program. The law aims to prevent professionals in these fields from trying to recategorize their income as tips to take advantage of the new deduction. With that being said, you also can't claim tips that have been negotiated. This is a subtle but important point. For example, if someone told a client, "Hey, I'll give you a big discount, just pay me a bigger tip." At least from my understanding, that would not qualify. The tip has to be truly voluntary, not a prearranged part of the payment. The bill specifies that these rules will only be in effect through the 2028 tax season. That is, of course, unless the government decides to extend the provision. So this is a fantastic opportunity for the next few years, but it's not necessarily permanent. Individuals with a modified adjusted gross income, or MAGI, of $150,000 or less, or $300,000 for married couples filing jointly, qualify for the full $25,000 deduction. Once your income goes above these limits, the amount you can deduct is reduced. The law specifies a reduction of $100 for every $1,000 of income you earn over these thresholds. Now, if you aren't sure of how a tax deduction works, let me break it down real simple. A deduction allows you to reduce your gross income in order to determine your taxable income. Think of it this way. Your gross income is all the money that you've made. The government lets you subtract certain things from that, and the amount left over is your taxable income. That is the number that the IRS uses when determining how much taxes you owe. So depending on your income level, a $25,000 deduction could lead to significant tax savings. Something else to keep in mind is that tax filers not itemizing their returns are still able to take the new tip deduction along with the standard deduction, which is being increased to $15,750 for single filers. For those that aren't sure of what that means, let me do a quick breakdown of the difference between itemizing and using the standard deduction. Most people, when filing their taxes, can choose two deduction methods. The standard deduction is a fixed dollar amount that you can subtract from your income, with the amount depending on your filing status. Alternatively, you can itemize deductions, which involves adding up all of your specific eligible expenses from the year. This adds more complexity, but could lead to a higher deduction depending on how many qualifying expenses you had throughout the year. Now, the IRS, the folks who actually write the rules of how to apply these laws, have not yet released their final guidance and regulations regarding this provision. So keep in mind that there will likely be more clarifications later on, so it's important to stay tuned for those updates. So if you're a tipped worker, this new law could mean a big boost in your take-home pay by reducing your federal income tax burden. But remember, I'm just a guy on the internet, so make sure to talk to a certified tax professional to understand how all of this will impact your specific financial situation. Thank you so much for watching. I hope this was helpful. If it was, do me a favor and hit that like button and subscribe for more content like this. And as always, I'll see you next time.